and what we're expecting in the FX space moving forward. Lukman, good morning.
Good morning.
All right, let's start off with the Fed, Lukman. It seems that they've set a more dovish tone, and that seems to have had an impact on Forex markets over the last couple of days, particularly with the dollar weakening in recent sessions. If the dollar weakness continues, what are some Forex pairs that might be worth looking at for Forex traders out there?
Thank you again for having me here today. Yeah, so with the dollar, we can see that the dollar has actually been attacked from all directions due to a combination of domestic and external factors. Domestically, yes, a patient Fed has now fueled speculation over the Fed taking a pause on rate hikes, but also in the United States, we have the fading fiscal stimulus and the impacts of the 35-day government shutdown threatening the dollar's safe haven status. So a weaker dollar will be a welcome development to most major pairs, especially emerging market currencies. But I have two key pairs I find of interest. The first one is the dollar yen, and the second is dollar CAD. The reason why the dollar yen will be of great interest is because we have a strong weak setup. So we know that the dollar is weak due to Fed pause speculation, and the yen is likely to benefit from growing risk aversion due to the unfavorable market conditions. With the dollar CAD, it's the same story. Dollar weakness, and the CAD is seen appreciating as oil prices trade higher.
And that's the Canadian dollar, just to clarify for our listeners, right?
Yes, the Canadian dollar.
All right. Let's move forward now, Lukman, and look at what's going on over in Europe again. And it seems that there are still some issues with regards to the impending Brexit. Theresa May being sent back to the EU to renegotiate in recent days, but it seems that that the folks at the European Union are not having any of it. They say that the agreement that they came to last November will stand. What happens now for the British pound, and what kind of risks might there be inherent for the sterling in the coming weeks?
When we look at the British pound, it's clear to see that it actually remains highly reactive to Brexit-related headlines. And yes, we know that Theresa May is heading to Brussels to negotiate the Brexit withdrawal deal, but the European Union has on repeated occasion actually warned that the backstop is not open for negotiations. So naturally, this actually opens the fact that the Prime Minister's trip to Brussels could end up in complete disappointment. This disappointment represents a sense of uncertainty, and uncertainty naturally is bad news for the British pound. However, though, it seems that expectations continue to mount over the potential extension of Article 50, which removes a major element of uncertainty over Brexit and reduces fears of a no-deal outcome becoming reality. So, in fact, we can actually see the pound trade higher in the near term based on these expectations. But when we look at things in the medium to longer term, it's known that the Brexit-related uncertainty continues to cloud the pound's outlook.
Now, we're still speaking to Lukman Otunuga of FXTM. And Lukman, I think you'd think that the Brexit saga would draw a lot of attention to the sterling, but there were reports that in the middle of this week, the offshore Yuan or renminbi was one of the more heavily traded currencies in FX markets. What do you know about this, and why has there been a pickup in interest in the Yuan? Is it just because of these trade talks, or is there another underlying reason for why it seems to have caught the eye of many a Forex trader in recent days?
When I looked at the Yuan this week, the first thing that came to my mind was that investors who were actually waiting for an opportunity to purchase the Yuan were given the thumbs up, and it's mostly due to a dovish Fed. It's a combination of narrowing interest rate differentials, easing concerns over easing concerns over trade developments, and actually fears over trade tensions impacting the U.S. economy, all directing investors to the Chinese yuan. And this was the story to other emerging market currencies. It was not only the yuan that gained interest. Yuan bulls actually are in for the win this week. We can see that the Chinese yuan is actually trading at levels not seen in over 6 months, just ahead of the Chinese New Year holidays. Moving forward, we can actually see the yuan edging higher if optimism continues to increase over trade tensions easing and the dollar continues to weaken.
And Lukman, finally, it seems that risk on is a theme in equity markets. Is that the same in Forex markets from your point of view? And if that's the case, where does this leave gold, which is seen to have benefited from a flight to safe havens in recent weeks?
Yes, we can actually see it's been an incredibly bullish trading week for gold. It's trading around levels not seen in over 8 months. So the dollar's appreciation is based on, number one, dollar weakness, number two, lower bond yields, a dovish Fed, and geopolitical risks. All these are actually stimulating the flight to safety, ultimately sending investors towards safe haven gold. The yellow metal was actually poised to conclude January on an incredibly positive note, and as long as global growth fears remain a major theme, gold is set to shine in Q1.
And just to remind our viewers, also our listeners right now, that gold spot prices are trading about $1,318 a troy ounce at the moment. Lukman Otunuga from FXTM joining us today from London. Thanks for your insights and for helping us recap what we've learned in the Forex markets this week.